Vikram Limaye, Deputy MD of IDFC, joins us right now on the show to not just talk about the business of IDFC, also talk about what the macro cues are shaping up like. Thanks so much for joining me, Vikram. Great having you. Good morning. Just start off with the macro and the October IIP weaker than expected, CPI at 2-year high. Now, does this make the RBI repo rate hike of 25 bips inevitable in 3 days from now? What's your view?
I think most people are expecting a hike in repo rate, and the governor has been quite clear that he's focused on making sure that inflation is under control. Inflation continues to remain sticky, and in fact CPI has moved up to 11%. So there's a very good likelihood that the Reserve Bank will increase rates by 25 basis points.
Vikram, so what's the sense that you're getting? Is there a risk of a cumulative 50 bips hike from December to March, given the high inflationary expectations? And if at all QE taper is aggressive this time around, what is it that you're expecting then?
It really depends on what happens with inflation. I think it's a difficult situation because we're facing a situation where you have low GDP growth and high rates. So that combination is never easy to manage, and it is important to make sure that growth picks up as well. I've said before that the reduction in GDP growth has less to do with interest rates and more to do with sentiment and confidence surrounding the investment cycle. So we have to figure out a way to get investments back. And I think some of the inflation that we're facing is in fact supply constrained and not necessarily demand led. So it is a difficult situation for the Reserve Bank to manage as well, given that we're in a low growth rate environment.
Yeah, the question, Vikram, really is that while there may be a 25 bips hike, and many argue that there could be a 50 bips hike too until March, most people are of the view that until May or until June, there will not be further rate cuts that could come in. It could well change with CPI numbers coming down, but as of now, the consensus view seems to be that. What does this do to your borrowing costs if indeed there are no rate cuts that come in for the next 6 months? And what does that do to your margins as well?
Our cost of borrowing is really largely linked to the bond markets because we borrow more from the bond market and less from the bank market, given that banks' base rates are higher than what we're able to get in the bond market. So as long as the bond markets are active and liquid, I think our borrowing costs will be a bit lower than the bank base rates. I'm not sure that they will necessarily move in parallel with the increase in repo rates in terms of one-for-one increase in our cost of borrowing. There could be some marginal increase, but I don't expect a one-to-one increase in our borrowing costs linked to any kind of increase in repo rates.
What about the IIP data though, Vikram? Are you getting the sense that we may have bottomed out this time around and perhaps the investment climate could pick up post this?
It certainly feels like we're close to the bottom in terms of GDP growth as well as sentiment. How quickly the investment cycle picks up is really a function of a couple of things. One is resolution of some of the pending matters for which government has actually made some positive announcements in the last 4 or 5 months. We have to make sure that those get implemented and projects and developers actually see the benefit of those announcements. Second is obviously people are in wait and watch mode to see what the election outcome is. And if that is positive, certainly that will give an impetus to investments into the economy. As I've said before, investments do come back with a lag, so you don't expect investments to start feeding into growth right away. But once sentiment comes back, I'm sure that the investment cycle will pick up as well. So that could be the second half of next year.
In fact, that was going to be my question. Do you see any signs of pickup in disbursements growth? And because in Q2 you had mentioned that you see flat credit growth for FY14. Do you see FY15 credit growth to be better?
That's again contingent on what I've said. If the uncertainties we're talking about remain unresolved and the election outcome is negative from a sentiment and confidence perspective, then obviously we could be in a prolonged period of low GDP growth and investments not picking up.
Interesting. A couple of your businesses which I wanted to speak to you about, one of them is the kind of money that flows into IDFC PE, and I see recurring news flow about that coming in for various projects, be it infra or otherwise. How is that side of the business shaping up for you?
Actually, we've done very well in raising an infrastructure fund in a very difficult environment. As you know, the sentiment surrounding India in the last 12 months and particularly surrounding infrastructure has been quite difficult. We've announced first close of $650 million. In a couple of months, we should be able to get to $1 billion, which is a terrific effort given the environment we're in. It's also a very interesting time to have capital to invest in infrastructure because there will be assets that become available, and given where we are in the cycle, it should be possible to make good investments that could result in interesting returns for investors in our funds. So I think there is a demand for risk capital in infrastructure. There are a lot of sellers of assets and very few buyers, so we're actually very well positioned based on the fundraise that we've done to actually capitalize on that opportunity.
Vikram, in the second quarter, you had mentioned that your gross NPAs could inch up to 1% and above as well. Given the current domestic environment, do you still maintain that guidance?
Yes, absolutely. I think there are risks in the environment. We cannot be immune to all the risks that we see around us, given the infrastructure environment that we're in. So we maintain that guidance of 1 to 1.5% NPAs.
Okay, and you mentioned about one or two sectors broadly, and you mentioned that the disbursement growth would be contingent on a number of factors that you mentioned. How do you see that shaping up in the run-up to the elections? Because the markets may start discounting a positive election outcome well before the election outcome does come about. But what would happen to the actual growth? Does that pick up even if a favorable government comes into play?
No, I think there are two aspects to it. One is what I outlined was to try and debottleneck projects that are actually currently under construction or have actually been completed but for some reason are not firing at full capacity. That is something that we need to solve for anyway. The point I was making was surrounding new investments in projects and the sentiment surrounding new investments coming into infrastructure. And that, I think, will come with a lag provided we have resolution of execution challenges that existing projects are facing and an election outcome that gives people confidence that there will be stability and there will be pro-growth policies.